Welcome back. It seems that green is the new gold for investors, according to a UAE-based global carbon market leader. Trading professionals say that gold investors are now switching to carbon credits, with forecasts of over 25% in returns for the ethical commodity this year alone. Franklin Connellan, the head of investments at Advanced Global Trading, states that since its inception in 2005, the carbon market has risen by 960,000%, proving that the commodity is driven by market supply and demand and is uncorrelated to other financial markets. Many companies are now looking to increase their commitment to reducing their carbon footprint as well.
Gold as a commodity is very, very similar to carbon as a commodity, and they're also both tradable commodities, which is important to know. The only real difference is that gold itself is exchange traded. So it's affected by economies of the world, natural disasters, wars, for example. The beauty of the carbon market is that it's solely driven by supply and demand. Okay? And this is why the market has risen 960,000% since its inception in 2005. The World Bank puts it at a record level of $176 billion, and this is why carbon is now known as the new safe haven.
Traders can now also monitor their carbon credits from their mobile smartphones through the AGT application, allowing investors to view the current commodity rate, transfer credits in addition to viewing their transaction history.
Over the last 12 months, carbon has seen a return of over 22%. Over the last 18 months, a phenomenal 41%. We can comfortably predict that the price will increase by a further 15 to 20% by the end of the year.
With 8.8 million visitors expected this year, Dubai is considered to be the Middle East's biggest tourism hub, which leaves no surprise as to why the Four Seasons Hotels and Resorts Group has chosen to expand in the Emirate. The Canadian hospitality company, in collaboration with UAE-based holding company Bright Start, announced this morning their plans for a resort property in the heart of Jumeirah Beach. Expected to be completed and open by mid-2014, developers H&H Investment and Development have been working closely with international interior designers and architects over the past 2 years to create and design a unique Andalusian-inspired property. The resort will have 237 rooms, including 49 suites, and will cater to both leisure and business guests.
Jumeirah Beach is the crossroads of everything in Dubai. It's a perfect leisure destination with 270 meters of absolutely spectacular beachfront, as well as close proximity to the Dubai Business District. So we believe this location will offer something very special for leisure travelers, for business travelers, and for people who need to combine both business and leisure in their busy day.
We brought in the operators and the designers from day one all together as one team. And designing a hotel takes a long time. There are so many different components. It's like doing 15 or 20 projects all in one, and they all have to have certain synergies and operations. It's not only designing a pretty building, and it also has to function properly, so it does not create any kind of hassle for the operator and for the guest experience, which is the most important. And that's why we took our time into selecting the architects, and we've done several workshops and meetings, and now we're on ground.
Shahab Lutfi, CEO of H&H Investment and Development, also revealed unique features of the project.
It is one of the things that we worked with the design team of Four Seasons, and we thought we want something unique. There's so many ballrooms in Dubai, but there's no ballroom on the beach. And we had the opportunity here to create actually banquet facility along with a large ballroom that is around 600 square meters, indoor space, that actually could be accessible to the beach. So there is a large lawn area where you can have the function indoor that extends to the outdoor space also. And 6 to 7 months a year, it's excellent weather here. So,
as we reported on Tuesday, the UAE and Saudi Arabia are the largest lenders in the MENA region, with Emirates NBD topping the list in the latest Forbes Middle East study. And to find out more, we earlier spoke with editor and information specialist at Forbes Middle East, Mr. Yorios Retsanas.
The reason behind Emirates NBD coming out on top is a large proportion of the bank NPL ratio, which has reached 13.70%, is due in part to involvement with the Dubai World. They had an agreement with Dubai World that allowed them to borrow between $6 billion and $7 billion, which led to non-performing loan classification. Apart from that, they did some business structures and operations that allowed them to get such large loans. This was also the reason why NBD's NPL ratio soared so higher than other banks. Furthermore, if Dubai World was taken out of the NBD portfolio, then the bank's NPL ratio would fall to between 7 and 8%.
UAE-based Arkan Building Material Company announced today that it has completed the refinancing of existing debt to enable it to fund a pipeline of new projects in the UAE with a 1.4 billion dirham loan. With that, let's look at the stock indices across the GCC. The G20 Summit in Mexico has been dominated by a global effort to restore confidence in the euro. Emerging countries boosted their pledges to the IMF's global firewall, nearly doubling the fund's resources to $456 billion. So will this amount be enough, and what can we expect from the meeting? To tell us more, we earlier spoke with Dauba-Pantanacce, the senior economist at Standard Chartered Bank.
The expectation for the G20 meeting were very low, and I think that we didn't hear or learn a lot of new things coming out of this G20 communique. The main point that we learn is that the IMF firepower has been almost doubled and is reaching now almost $500 billion, which is substantial. But this is something that had been already hinted at earlier on in the year, in April, in fact. And I think it's very important to remember that it is also conditional on the fact that the IMF would implement the 2010 rule that would give the BRIC countries, which are major contributors to this new money, would give the BRIC countries a higher voting power within the IMF. The second element is that the new money coming to the IMF won't necessarily flow automatically to the debt-stricken euro countries. Each country, such as the US, which is the biggest funder of the IMF, have its says in where the money goes. I think that very importantly, what we learn on the side of the G20 is that the three Eurozone countries belonging to the G20, which are Italy, Germany, and France, did commit to bring down the borrowing cost of peripheral debt countries, such as Spain or Italy. And what that means is that probably Germany is less now reluctant to use the rescue fund to actually directly buy sovereign papers to bring down the borrowing cost, typically of Italy, where the 10 years bond yield have been flirting with 7%, which is deemed to be unsustainable level.